With the Federal Reserve having announced their monetary policy meeting results yesterday, the 26th of January, we thought there was a good opportunity to readdress one of the key risks coming into 2022, which we highlighted at the back end of last year, is that, is the Federal Reserve maybe making a policy misstep? So what did the monetary policy minutes say? Well, first of all, they said that it's likely that they would end tapering by the end of March. Two, that interest rates could potentially start rising. Now, they didn't give a date and they didn't give the size, but they didn't rule out 50 basis points at all. So the market's now thinking instead of June of 2022, it's going to be March of 2022 where you'll see the first rate hike by the Federal Reserve. And third was that employment is running very high, and therefore inflation should remain above target for the time being. Now, the market kind of liked that statement, but in the press meeting afterwards, the Federal Reserve Chairman Jerome Powell was super hawkish, and this is what he said. He said, unlike the last time when interest rates were rising between 2015 and 2018, the economy now is much stronger, very much stronger, which indicates that interest rates could be a lot higher. Two, unemployment rate was running a lot lower. And thirdly, inflation was a lot higher, and a lot higher than our expectations. So in all of that, the market now expects a more aggressive Federal Reserve going forward in terms of interest rate hike. One of the things that he would be looking at, and the other members of the Federal Reserve, would be tightening of the balance sheet or reduction in the balance sheet. And again, that is something which is left open-ended. So the market, in our view, is now going to worry about interest rates rising, the balance sheet reducing, so therefore less accommodation for the markets in terms of liquidity, all at a time when the economy could be slowing. And I think that's what the market's going to worry about. So the volatility will remain because we don't have a clear indication of when interest rates are going to rise, how much by, and when and how big is that reduction in the balance sheet going to happen. So volatility will remain for the next quarter at least. So this is going to have an impact on growth stocks in particular, where we've already seen huge volatility. Markets, people are saying, well, markets have already corrected. They corrected, anywhere between 7 to 11% from their highs. It's not really a big market correction at the moment. And again, I think the market will worry about what kind of PE contraction we're going to see with interest rates rising.